There is still a great deal of confusion over Bitcoin's taxation more than a decade after its launch. Although it was intended to be a tool for everyday transactions, cryptocurrency hasn't yet taken off as a form of payment. In the meantime, it has gained popularity among traders and speculators looking to capitalize on its volatility. According to the Internal Revenue Service, cryptocurrency will be treated as an asset similar to real estate. The IRS stated requesting information on its Form 1040 in 2019 to ascertain whether the taxpayer has any crypto transactions during the relevant tax year. Assets are subject to a variety of taxes depending on the type of transaction. However, there are several exceptions to the constantly changing tax laws due to Bitcoin's distinctive qualities and use cases. The US Treasury acknowledged the growing significance of Bitcoin when it declared that investment and transactions involving Bitcoin cannot be regarded as illegal. Virtual currency like Bitcoin, Ethereum, or smaller altcoins are recognized as property, and generally, conventional tax law apply to these assets. According to the IRS, virtual currency is a digital representation of value distinct from the representations of the US dollar or foreign currency. If a virtual currency has been held for 1 year or less, it is considered a short-term gain or loss when the currency is transacted with. A gain or loss on virtual currency is regarded as long-term if it has been held for more than a year. The selling of virtual currency now requires you to record any capital gains or losses on the asset. The deductibility of the taxpayer's capital losses is capped. Therefore, any gains or losses reported are also capped. IRS Publications 544 on sales and other dispositions of assets serves as the basis of this tax law. A taxpayer's Form 1040's Schedule D is where they record their capital gains. Long-term capital gains are frequently taxed as ordinary income and asserted at the same tax rate as the taxpayer's salary or wages. In the broadest sense, gains and losses on the sale of cryptocurrency are treated the same as other capital assets such as stocks, bonds, precious metals, or certain personal property. According to the taxpayer's tax situations and income, long-term capital gains are frequently taxed at a more favorable rate. So, what are those taxable Bitcoin transactions? The IRS has issued detailed instructions regarding transactions involving digital assets that must be reported on a tax return. Be aware that the volume of these transactions may make it challenging to keep track of every transaction. Cryptocurrency users and investors are urged to get advice from a tax professional to ensure that all transactions, including the purchase, sale, exchange, gifting, and mining of digital assets, are accurately recorded. Bitcoin tax basis. The cost at which you acquire Bitcoin, in the broadest sense, serves as the tax basis for calculating your gain or loss. Assume, for instance, that 100,000 Satoshis were purchased at the price of $20,000 for Bitcoin. The acquisitions would have a $20 cost basis. In this scenario, if the Bitcoin was sold for $25, there would be a $5 taxable gain. $6 would be a loss if the Bitcoin were sold for $14. So, the more convoluted the transactions are, the more complicated the tax foundations of Bitcoin gets. For instance, receiving tokens through airdrop or in exchange for services could be free for an investor. In the majority of those scenarios, the fair market value at the moment of acquisitions would serve as the basis for Bitcoin or other digital currencies. This tax status is comparable to how equities and bonds are treated. Tax implications of Bitcoin mining. Mining for cryptocurrencies is regarded as a taxable event as well. The coin's price at the time you mine it determines its fair market value or cost basis. The good news is that you can deduct business expenses for mining tools and supplies. Depending on whether you mine the cryptocurrency for personal or individual benefits, those deductions take on different forms. You can claim the deductions to lower your tax liability if you own a mining company. However, if you mine the cryptocurrencies for your gain, you are not allowed to claim these deductions. Tax implications of swaps. Some have suggested that the Internal Revenue Code's Section 1031 should classify converting one cryptocurrency to another, such as from Bitcoin to Ether, as a transfer of like kind. The IRS permits you to postpone paying income tax on some transactions. However, the IRS determined that such transfers do not meet the requirement for a like-kind exchange under Sections 1031 in a memorandum of the Office of Chief Counsel issued on June 18, 2021. Additionally, the Tax Cuts and Jobs Act of 2017 prohibited like-kind transfers outside of property purchases, ending the practice. If you receive cryptocurrencies through an exchange transactions, the exchange will record the value of the digital currency you got at the moment of the transaction. If the transactions is carried out off-chain, the fair market value of the exchange serves as the basis for the exchange. Otherwise, the basis will be recorded on the distributed ledger of the controlled or decentralized exchange. Tax implications of hard forks. When a blockchain splits, which implies a change in protocols, hard forks of a coin take place. A new coin is created with differences in mining and use cases from its predecessor. The original cryptocurrency holders might receive new coins. Developers of new coins often employ this technique, commonly referred to as an airdrop, as a marketing gimmick to spur interest and usage. The IRS ruled in 2019 that hard forks do not generate gross revenue if the wallet owners does not get crypto units. On the other hand, airdrops count as gross revenue when the holder receives tokens of a new cryptocurrency following a hard fork or from coin marketers. The tax amount in the latter situations is determined by the quantity and timing of new coin received by the owner of a crypto wallet. Regular income is taxed, including airdrops. Tax implications of gifting Bitcoin. Donations made using cryptocurrencies are handled similarly to those made with cash. They are tax deductible but based on their AGI. Donors are only allowed to write off a certain amount. A coin's fair market value will be determined by an appraiser using the coin's market value at the time of donation. On the price gain, the donor is exempt from paying taxes. The IRS established an annual gift tax exclusion every year. Taxpayers are permitted a $16,000 annual deductions per donee beginning in 2022. This cap has been raised to $17,000 for 2023. It is difficult to calculate the fair value of the cryptocurrency in purchase and sale transactions due to the volatility of the cryptocurrency market. It is highly recommended to keep track of transactions as they take place because it could be challenging to collect financial data later, even on distributed ledgers. Finding the right accounting approach to use for crypto taxations might be challenging as well. Although the IRS has approved very few uses of last in, first out, and highest in, first out for cryptocurrency trading, they have the potentials to reduce taxes. First in, first out is the most commonly used method for cryptocurrency accounting. Most of the time, donating cryptocurrency to a nonprofit will not result in a taxable transaction. The fair market value of a digital currency at the time of the transactions is usually the foundations of the contribution. How can I avoid paying taxes on Bitcoin? The simplest way to avoid paying taxes on cryptocurrency is to avoid selling any virtual money within the tax year. Although receiving Bitcoin through an airdrop or in exchange for services has tax repercussions, the majority of taxable events are brought on by the sale or exchange of the cryptocurrency. Does the IRS know I own Bitcoin? Some centralized exchanges have Know Your Client documenting obligations in which investors must upload their photo identifications and some personal information. A Form 1099-B or Form 1099-K from your trading platform notifies the IRS that you have conducted business with the platform. What happens if you don't report taxes on Bitcoin to the IRS? Tax evasions happens when persons intentionally fail to repay taxes on any type of income, including Bitcoin, salaries, wages, stocks, and other types of assets. The IRS may audit you if they have grounds to believe you have committed tax fraud. Remember that trading platforms might publish tax statements informing the IRS of your involvement in Bitcoin transactions. The market for cryptocurrencies is exciting, unstable, hazardous, and developing. Those who buy, sell, or use Bitcoin for other purposes should be aware of the tax repercussions of their decisions. Most transactions result in taxable events, and the tax basis of any Bitcoins owned is often either the cost basis at acquisitions or the fair market value at acquisitions. Deliberately not remitting taxes on cryptocurrency transactions is considered tax fraud. Alright guys, that's all for today. If you found this video useful, please do well to give this video a thumbs up and hit the subscribe button as well.